Today, I want to talk about how liquidity in both AMC and the overall market is gone, and how this will cause margin calls in these over-leveraged hedge funds. I want to explain why UBS is delaying their second quarter results, how collateral requirements are increasing, and how this will ultimately lead to margin calls in these major banks and hedge funds. So stay tuned and let's make some money. And now I'll dive straight in with the key information. So, Frank tweeted saying UBS, imagine that, and just why the delay? Surely it can't be those bullet swaps on GameStop and on AMC, and who knows how many other derivative plays, nor naked shorting. It says Credit Suisse was laden and nearly ruined by Archegos, but refused to fix the hole and let it continue to worsen. UBS went in, but poked the hole and made it even bigger. Now UBS is telling you to go away and that nothing interesting is happening here, and that UBS is considering delaying its second quarter results until the end of August. But why would it be specifically the swaps causing this specific UBS reporting delay? Well, swaps are contracts that are executed between two parties, and the terms of the swaps are typically only known to the parties to the contract. So when UBS was effectively forced to take over Credit Suisse in March, do you think that UBS had the opportunity or time to go and look at these various swap contracts that they were now the new counterparties for? The delay in reporting will make sense from a practical perspective because UBS is now likely aware of exactly how much of a mess they've dug themselves into. He said to keep the game going, you need liquidity, and it seems that UBS is obviously running out of liquidity and has some terrible earnings to announce, and that's why they want to delay the announcement until as late as possible. They don't want people getting wind of just how bad UBS's results are and just how much of a loss they're going to take for the acquisition of Credit Suisse, and they're desperate for people to leave their money at UBS. Therefore, instead of spooking the people and announcing terrible earnings, they're just not going to announce and hope people will leave their money so they aren't short on liquidity. Now you may ask what goes well with an over-leveraged bank like UBS that's short on liquidity and has tons of losses to announce. Well, increased capital requirements. Unusual Wells tweeted saying that US banks could face a 20% hike to capital requirements, and as Finance Lancelot tweeted, it sounds like it's just more liquidity drain. These banks are going to need to have more cash on hand, less money invested into the markets, and be less over-leveraged, which obviously means these banks are going to have to sell their stocks or cover off of some of their short positions to reduce their current leverage amounts. If banks are already struggling to meet capital requirements, what's going to happen when they increase these capital requirements by an additional 20%? Margin calls. And what goes well with banks and hedge funds that are struggling to meet their already high capital requirements that are just about to get even higher? Well, it's hedge funds taking on even more leverage and even more risk. Travis tweeted saying for the entire retail ownership of AMC remained the same, which it pretty much has, going from 4 million investors to a whopping 3.8 million investors, which is a very small decline, but the price went from $72 per share down to $4 per share. What does that tell you? We've seen a small 5% decline in the entire shareholder base, but over a whopping 90% decline in the stock price. So what does that actually mean? Well, Travis has said that short sellers have naked shorted the price all the way down, trading with themselves, doubling, tripling and quadrupling down on their short positions and ladder attacking the stock, which has not been profitable for them. These shorts haven't been closing out of their short positions in profit, they've been doubling, tripling and quadrupling down on their short positions. These hedge funds have been putting up more collateral on their larger and larger short positions that they cannot escape from without generating a loss. Effectively, the only way these hedge funds have pushed the price of AMC down is by trading with themselves, ladder attacking the stock down. Now, if they wanted to actually close out of those short positions, they'd have to buy back all of those shorted shares, pushing the price exactly to where they started from. That means the price would rocket straight back to $72 per share, and the shorts would then be in exactly the same place that they were back in January of 2021, which is still very heavily over-leveraged on illegal short positions. To put this into a relatable example, basically the shorts have crashed their car, and to try and cover up the damage, they've created loads more dents in the car to try and hide that car crash. Even if the shorts then go and fix all of those additional dents they've created, they still have that giant car crash impact that's still left and still needs to be repaired. As Jan-Jack tweeted, he said the AMC short sellers haven't been able to put up additional collateral since before January 28, 2021. The fact is in the report produced by the House Finance Committee, where it talks about how the DTCC waived margin calls. The DTCC had waived collateral requirements for brokers and hedge funds before and after the January 28th event, allowing them to keep their short positions in so-called meme stocks. Recently, FINRA postponed both collateral and margin requirements for brokers until October of 2023. When these margin and collateral requirements come back into effect in October, I expect to see some massive margin calls. Whether the margin requirements will be delayed again is so far yet to be seen, but I think that FINRA can only postpone these collateral requirements for so long until forced margin calls are enforced. Stonks Batman has tweeted saying, so let me get this straight. People are out here thinking the short seller strategy is to double down and short after the conversion and reverse split. He said, sure, it's possible, but imagine doubling down short on positions where they've already doubled, tripled and quadrupled down on, holding that position and then receiving news that AMC is debt free. As I've said before, I don't think it's long until AMC releases a profitable quarter, as they're already producing profitable adjusted EBITDA, and when they do generate that profit, they can continue paying down that debt. He added, I'm not saying it won't happen, but I am saying it'd be stupid for it to happen. I'm not going to underestimate the stupidity short sellers have, so maybe it does happen. I personally think the shorts are going to try and double, triple and quadruple down on their already doubled, tripled and quadrupled down short positions by trying to short after the conversion and reverse split, because at the moment it's pretty much their only strategy. Their only strategy right now is to try and push AMC below $2 or $1 per share and get AMC delisted from the stock exchange, just like Bed Bath & Beyond was. Because we know that AMC won't be going profitable when it's generating profitable quarters, and we know that AMC will be able to pay down its debt and continue generating more money. And as AMC continues to generate more and more money, more and more institutions will continue buying AMC stock, pushing the price back upwards against these shorts. And what goes well with already struggling banks, already struggling hedge funds that have already doubled, tripled and quadrupled down on their risky and illegal short positions? Well, it's more liquidity drain. Genevieve tweeted saying a flood of treasuries is about to hit the market. With the debt ceiling signed, the government needs to quickly refill its coffers. Liquidity will fall by $1 trillion as banks sell off $1 trillion worth of stocks to buy $1 trillion worth of treasury bills, and that'll affect every asset class, according to JP Morgan. JP Morgan said this is a very big liquidity drain, and we've rarely seen something like that, only in severe crashes like the Lehman crash. And Bigham said it's exactly what I've been saying, so get your popcorn ready for when these bonds hit the market, along with these 9-month swap contracts getting processed. UBS are obviously trying to prepare for this coming liquidity drain and for the renewal of their 9-month swaps by delaying the release of their earnings. Right now, everything seems to be lining up so well. We've got UBS struggling and delaying their earnings announcements. You've got more liquidity drain due to increased capital requirements. And you've got more hedge funds that have doubled, tripled and quadrupled down on their short positions that are already struggling to meet the already high capital requirements. And as soon as these collateral and margin requirements are enforced by FINRA and the SEC, then forced margin calls will also be enforced. And that'll end up causing massive margin calls in not just these hedge funds, but also in these major banks like UBS that have already doubled, tripled and quadrupled down on already doubled, tripled and quadrupled down short positions. And that's why, as the Las Vegas Ape tweeted, he said if the ape conversion and reverse split was no big deal, then there wouldn't be an endless army of FUD about it, and AMC wouldn't be held hostage in an infamous Delaware court over that conversion. He said this all screams that they are terrified of these actions. These shorts are terrified of the reverse split and the conversion. And that's potentially because this could be the trigger for that giant wave of margin calls and of liquidations that times so perfectly with this coming liquidity drain. So guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell because that way you'll be alerted when I upload a new video. Cheers.